What a great time that was. 2020, 2021, 2022. Everybody had money. The government was literally giving it away. 3 Stymie checks, PPP. All you had to do was say, oh, yeah, I had employees and I really need help. And you'd get 15, 20, 30,000, $50,000. The government was literally giving it away and things were just wonderful. So let's look at a couple of charts and see what we're up against now, because all that wonderfulness we have to pay for now. Let me go to my slide here, and you can take a look at what's next. So look at liquidity pumped this bubble, and liquidity is going to pop it. Now I've been around, so I'm going to tell you right here, right there. If you remember Ben Bernanke, he billed himself as a student of the Great Depression, and he told everybody he knew exactly what to do. He was going to liquefy the system, and that was the problem with the Great Depression. And he did. He liquefied the system. Let me open this up a little bit so you can see this. He liquefied it. So right here, so we're in the great financial crisis. It was a terrible time. Here I'm in Phoenix, Arizona, of course. We're wearing the crown for bad business decisions for real estate. And Ben Bernanke just put money in like crazy. Never been done before. You can see how steady this line was. This is liquidity, total assets that were put in. And then right there, within a matter of weeks, an enormous amount of money was put in, and they continued putting in. Now, to their credit, there was an awful lot of liquidity destruction. We had an awful lot of defaults going on. And of course, when you have a loan of a $300 million loan that goes bad, that is deflation. We had a deflationary event right here. People don't realize that. This was a deflationary event. And we had enormous amount of credit and liquidity being destroyed, and they were putting it back in. So he probably did a pretty good job. However, they never stopped. So this just continued on and on and on. And then, of course, we got involved with more stimulus. And then look at here. So we're going to talk about this. So this entire time, so you wonder why if you'd bought a house. Now we bought a lot of properties right here. We were buying properties for $50 a square foot in Surprise, Arizona, 3 and 4 year old properties in pristine shape. We were buying for about $75,000. And liquidity was pumped and pumped and pumped and pumped and pumped, starting to take it out a little bit. If you remember 2019, we were starting to think we were going to have a recession. And you can see this is one of the liquidity models that we follow. You can see that liquidity is being taken out. Then we get into this problem. And interest rates, of course, are bottoming right through here. And bonds are topping. And then bingo, right here we get this enormous dose of liquidity. It went in everywhere. So all the corporations got it, the businesses got it, and it went 3 Stymie checks. Money was absolutely everywhere. It was so much fun. What do you suppose is going to happen when we do that? What do you suppose is going to happen? People had money everywhere. Interest rates were down in the basement. Now, Dr. Nenner and I did a video in November of 2020, and Charles Nenner said bonds have peaked. They're done. And rates were going up from there. And then, of course, it did. So a lot of all this liquidity was predicated, it was artificial, was predicated upon really, really low interest rates and the government stimulating and giving money. And stimulating they did. Let me open this up. Let me go to the next slide, because these are important slides. Let me just go to this and take a look at this. So Janet Yellen continued. So here again, you can see they just continued to add and add and add. So look at this: 42% of all U.S. debt ever issued was issued under her administration. Now, as liquidity is being put in, anyone that had assets, anyone, whether you had bonds, you had stocks, or you had real estate, all this was just exploding. This is called, the everything bubble. And you can see $6.8 trillion. And then we get here to the COVID, they put 8.4 trillion. So between the two of these, we've got $15 trillion just coming out of the Treasury and the Federal Reserve. Let me go to my next slide and look at this. So we thought we're going into recession. You can see it peak. This would be look right here, 2022. You can see it peak. Our liquidity model peaked, and you can see liquidity being withdrawn. And we're getting into 2022. Liquidity is being withdrawn, and it's no longer so much fun. Here we are, keeps coming down. If you follow my work, I thought Q4 2023 is when we went into recession. And bingo, we get to 2020, January 1st of 2024, and all of a sudden, we've got this increase in liquidity, quite a bit actually. And what is this for? Just right in front of the elections. So the government started hiring people, this extra money. And of course, what happens when you get this liquidity pulse is the stock market goes absolutely crazy and interest rates went down. My market, the real estate market, went crazy. And here you go. Liquidity bubble is deflating. You can see this. I got this from Zero Hedge just a month or so ago. It's still very good. So liquidity typically grows. Typically, you're putting in. Now, that's not typical. That really is not typical. Not 10%. We've just seen this. You can see this, how this is something that's happened. Let me just stop sharing. Let me go to and share this one over here and see if I can't share this with you and see if you can get that, if I can show that to you. Apparently not. Let me go to here and see if I can't share this and take a look at that. Share screen. And let's go to right there. Now look at this. Look what happened. Do you think this is normal? Look at it. This is the M1. So in April of 2020, it was, let's get right to the bottom. February 2020 was 1543, $1,539 billion. And this is July. They put in $5 trillion in about 8 weeks. And you can see, since this started in 1959, how the money supply was just staying very, very constant. We had a minor. Here we get into the Bernanke's. He's doing his new trials. This has never been done before, and he liquefied everything. You can see this huge increase in liquidity, which is driving prices up. This is great for me. This is great for my business. We had a steady increase all along here, better than normal, and then bang. Now, this has to be taken out. We have to take this liquidity out. So we went right up like that. It's come down a little bit. It's going to come down to here. It has to come out. It's artificial. That can't continue with this. Let me go back to my other slides here and let's take a look at that. Presentation, share screen. And let me go back to the money supply. So this is deflating. And this is rocket fuel. So when you start taking rocket fuel, we're going up, we're going to go into orbit, almost there. Uh-oh. No more fuel. What happens to that rocket when you run out of fuel? Just ask that question. So it takes a long time. This is like moving a aircraft carrier. It doesn't move right away, but it is coming down. Let me go to my next slide. Now, this came from Charles Hugh Smith. He thought about this years ago. He thought, what is going to happen when all this liquidity gets pulled out of the market? What happens? Now, liquidity blew the bubble. It's going to pop the bubble, and we're on the popping side. So let me just go to this, and let's just explain this just a tad. Over here, this is really, really fun. This is the accumulation phase. You can see that just as clear as a bell, accumulation phase and then the explosive phase. This This is when you're at your cocktail party saying, look, I just bought a property and it went up $40,000 in the last 3 weeks. I'm so smart. I'm going to buy another 3 properties because it's just so great. And then your friends decide they're going to start buying some things too. And all this time, these prices are going up here and they're unsustainable. This is not affordable anymore. And then you peak just like this. It peaks. And once it peaks, what exactly is a peak? What is a peak? A peak means the top. And when it gets to the top, means it's not going any higher. So that peaked June in 2022. So the liquidity actually peaked just a little bit before. But here in Phoenix, our properties, particularly in the affordable space, peaked in the median price in June of 2022. Now, maybe it was July in some of our neighborhoods, but the affordability. So we have a bifurcated market. Now, if you're buying in Scottsdale paying cash, you don't have an affordability problem. But most of the people who actually need to, they're working for a living and they have only so much money they can spend. And once they get beyond that, they can't afford it. That's called affordability. They can no longer afford the property. And that is what's happening with this. And it's right over. Let me go to the slide so you can see this. Now, here's the problem, is that once you get up here, it becomes no longer sustainable. So when you get a housing bubble symmetry, it's very possible, according to Charles Hugh Smith, and I agree with him, that we could see a 30% replacement. This would be devastating. Now, keep in mind that when the great financial crisis, nationally, we didn't hardly come down at all. Different locales certainly did. I mean, if you were in certain sections of the country, you were barely affected. But a lot of places here in Phoenix, I mean, I had properties that came down 60, 70%. That was a lot. But we need to take care of this, because here's Bernanke. You can see the fact it was coming down and he popped it. It was coming down and he added money to it, and it never really resolved. It should have come down even further. It never resolved. So what Charles Hugh Smith is thinking, and I agree with him again, is that in lots of locations that have gone crazy, excuse me, we could actually see a 60% retracement. And that would be devastating. So 60% retracement. Now, again, if you follow my other videos, and if you like them, please give me a like and subscribe. Take a look at some. We have talked about the fact that cap rates are telling us that properties are way overvalued. So I've had other videos where we're talking about how do you value these properties. And of course, when I was selling properties in 2006, 2007, 2008, the cap rate was 6 to 8. Then we went to 0% interest rates, and all of a sudden the cap rate went down to 4 or 4.5. Well, once it goes back up and normalizes, it normalizes to 6 or 8. Well, prices have to come down, and I'm talking about coming down significantly. So that's not what this one is about, but I'm going to tell you that that's a very possible thing that's going to come. Now, how does this happen? Again, we have a timing. So we're 14 years up and 4 years down. And honestly, we peaked here in Phoenix, Arizona. We know where the peak is, and it's not continuing up. It's peaked. It topped. Nada, not going up anymore. And where does it go from here? Well, it needs to normalize, and that means it needs to come down. Now, from here to when we bottom, it's about 4 years. And we're halfway into it. So that means that this has to come down and come down fairly fast. Now, that doesn't mean to say that every place in the country is going to crash. Not going to happen. But it does mean that a lot of places that are overvalued, Phoenix being one of them, we're not immune from this. But Texas and Florida, places in Tennessee and North Carolina, South Carolina, a lot of these places that got ahead of themselves are going to be in trouble. Then we start talking about our endangered cities like Chicago and Minnesota, Minneapolis, Seattle, Portland, Los Angeles, where you have bad governance and people are leaving. when things get tough, they vote with their feet and think, well, if it's going to be bad, I'm going to go start up elsewhere, and it's going to cause lots of problems. Remember, it only takes 2 or 3 comps in your neighborhood to change the comparables. And just by doing an income approach on an appraisal, now this is maybe technical for some people. It's really, really easy. It's just the cap rate. Remember, the higher the cap rate, the more valuable the property is. The more property earns, the more we want it. If it makes $15,000, that's great. If it's making $20,000, I'm willing to pay more for something that makes me more money. That's what happens. Now, if that starts coming down, we think we can have a compression of prices pretty severe. And that goes right back into what Charles Hughes Smith is saying. So we've got some problems coming. We have been very, very cautious, very, very cautious. We're preserving our capital at this point because I'm going to tell you what's going to happen. This is going to happen. We are going to get some buying opportunities. Now, obviously, once this thing comes down, we're going to have a long time to buy some properties. We're going to have some really good things, but this is not going to go straight down. We also have we've already seen the trophy properties. So we're starting to see trophy properties come to market right through here. And trophy properties are properties that typically are sold privately. They're held for generations. These are really, really good properties. And the owners, typically it's the grandson or the son that's gotten themselves into trouble. They overextended themselves because literally the last 3 or 4 years have been phenomenal for business. And you can think, that this is just going to continue. But if you've been in business for a while, this does not continue. So our group, we paid down debt. We secured our tenants. We did all the things we needed to do and get prepared. It's just like a lifeboat. We expect to use our properties to get us through this bad patch. And it's only going to be another 18 months to 24 months, and things are going to get better. But it could get severe. But we've seen this before. Those that over leverage, particularly properties, trophy properties, they are forced to sell them. And these are things that really don't come to market very often. And you get a shot at buying stuff that's just absolutely outstanding. Let me open this up a little bit so you can see this and take a quick peek at this. We think this is coming. I've got some timing on this if you want to either come to our seminars or we talk privately. It's not for a little while yet, but it is coming. And I think so buy number one is really, we're starting to see trophy properties. I bought one for myself. And again, I tell you not to buy, but a trophy property is different than an investment property. Trophy property is something that you'll keep for a long time. So I'm going to keep this for a generation. So we're still not invested in buying, taking new capital out and deploying our new capital, fresh capital. We're not doing that yet. I see that coming, but it's not here yet. And when it does, we are going to buy. I just had someone here in my office, and I told them we're probably going to buy hundreds of properties. We just want to buy everything. This is an opportunity that you only get once in a great while. Now, it's going to be very scary for a lot of people. If you are over leveraged, you are probably going to be in trouble. So if you have not put cash aside, if you're over indebted, you still may have a little bit of time, but not terribly much. We're already starting to see employment weakening. I think we saw a credit event. That's one of the signposts that's coming along. So I'm pretty sure we're on the path on our time continuum. It looks good. These time continuums, they get confirmed by events that happen in real time, and we're getting consistent confirmation on this. So I think it's coming. I think we're going to have a very, very bad market. Very, very bad. Lots of people are going to be very, very concerned. I wish I could be more optimistic, but I will tell you, I can see the end of it. So it's going to end. It's going to be kind of tough in between, but it's going to bottom, and then we're going to have an opportunity to buy some really good properties, and the cycle will restart. So we like that. Let me open this up and let me go to my next slide and see if we can discuss that. So I guess what I'm saying is get ready for this. Now, this is where I'm at. If you want to talk to me personally about your portfolio, where it's at, if it's in some of the endangered cities, maybe we need to start thinking of moving them. Maybe we need to start thinking, what are we going to do? So here's one of the exercises is if you have a property, say in Chicago, and you need to ask yourself, what do I envision this property being worth in 5 years and 10 years? Is it worthwhile moving it? Because I'll tell you that I just got, of the 15 major metros, Chicago was absolutely the worst. Phoenix was absolutely the best. Now, they've had a terrible run of governance and with crime and lots of problems with taxes and crime and bad governance in Chicago. You could do better elsewhere. And we do this with the 1031 exchange. This is often what we do. But it isn't something we just pick up the phone and decide one day. This is something we have to have several conversations as if we sell your property, what are we going to do with it? Now, I'm fine with selling 1031 exchanges because those properties are already at risk. They're at risk whether you leave them in Kansas or you live in Los Angeles or Seattle. They're at risk to market, go up or down, so we can move it. So if you do a 1031 exchange, we can defer the capital gains and really not have a capital gains event, a tax event, which is really, really good for us. And then you can move it to a much better market. So we've been doing a lot of that, and that's a conversation we can have. Also, we want to talk about getting you ready because we're probably going to finance. We've been doing a lot of cash for the last 4 or 5 years, but we're getting into a marketplace where we probably want to put some leverage on it. You get an internal rate of return when you have a little bit of leverage. And who pays that mortgage off for you? Your tenant does. So we want to do that. My very best to you. Bye-bye now.